Today's webinar is something that has been on my mind for quite some time, not only because of the topic, but because who is going to present it. We all strive for money, money, money. We put in time, efforts, our sleep, our peace of mind into making money. But how many of us actually make money work for us? Very few. And that's exactly what our speaker today is going to talk about. I have almost done half of my lifetime here in Dubai. I've made pots and pots of money. But those pots of money, if I don't utilize them well, how far can they go in making my life best that I can make of it? And that's very reason that we thought of this particular webinar and got somebody here on this webinar to talk about it. Our speaker today is somebody who is absolutely close friend of mine. I know him for almost 12 years, if I'm not mistaken. And he's always been a good advice for anything and everything. In his professional capacity, he's a certified financial planner. He is certified from a very reputed institute back in India. He is a member of the $1 Million Roundtable, which qualifies only 5% of top performing financial planners in the world. He is an author himself. And apart from all this that he's doing in terms of financial planning, supporting people, advising them, for me, he's not only a close friend, but he's a colleague in Toastmasters. He's a fantastic speaker. He's an engaging speaker. And today you would actually have a go at what he gets into his webinars or engagements, meetings, that what he's going to get to the table today. He's a very creative person, and his creativity, you would ideally see how he engages his audience today in this particular webinar. If you have any questions, you can post them on our WhatsApp number. And the WhatsApp number is 0556000176. Sorry. And now I leave the podium to Adil Kadri, my best friend and a speaker for today. Over to you, Adil.
Thank you. Thank you very much, Anupama. Thank you so much. In fact, first of all, it has been in our agenda for almost 2 years. We have been trying to do this seminar, but then now we got a chance. So thanks to you for inviting me, and thanks to Swati, because she was the one who helped me to prepare the presentation. And as in the beginning we said, I said to you that along with you, even I am also a technologically challenged person. So now let us get into the seminar and talk about an area which would be of an interest to many of us. Now, everyone wanted to make money. Who in this world do not like to make money? But then there are various ways and means to make money. What today I'm going to talk to you about is something to do with the laziest method or laziest way to become a millionaire. So let us see how best can I be of a value to you. Before I start the presentation, I wanted to ask all of you who are there, and you yourself can you can chat, put it into a chat box as well, that how many of us wanted to become a millionaire? Hello. When I do the physical presentation, I ask people to raise hands. And then I said that how many of you wanted to become, in fact, somebody in this audience are also saying not only raise one hand, they also raise two hands, because most of them wanted to become a millionaire. But my next question is that why do you want to become a millionaire? The reason why I'm asking you this question is that most of us want to become a millionaire, but they don't know why. The why is the most important thing. So let us see the areas of why today, why everyone should become a millionaire, and how everyone can become a millionaire. In fact, there are three ways to become a millionaire. The first method is something which we are going to discuss. It's a lazy method. It's a boring method. It's something which will take you there and make you a millionaire, but in a very, very, you can say in a disciplined manner and a very long time, you will become a millionaire. The second method and the third method is something which I wanted to tell you, but before that, let me just real time live case study. I will share it with you. The other day, I met with a friend of mine called as Munaf. Munaf was my classmate, and he was an average middle class family. The other day, I met with him, and I found him living in a house or living in a villa in Palm Jumeirah. Of late, we have been not in touch with each other, but then when we met, I wanted to know that how he managed to become so big. I took him out for a coffee and asked him that, Munaf, what have you done and how did you become so rich or so wealthy? So he started narrating his story that, Adil, I started started selling pens and then buying a cartoon for 10 rupees and selling it in 20 rupees and all those things. I said, fine, but then that's not going to make you a millionaire. Millionaire is big. Then what happened? He said, then I got married. I said, okay, even everyone gets married or most of us get married. But then what happened? So then he said, my father-in-law died. So the second method is that you can become a millionaire, but for that you need to find out somebody whose father-in-law is a rich person. Third method is something to do with buying a lottery, but becoming a millionaire is your chances are very, very less. One in thousands or one in crores, you will become a millionaire. But what happened is that most of the people who got this kind of a windfall, they tend to lose out most of their money which they have earned from or which they have won from the lottery ticket. So the third method is also not the correct method. So let's see the most boring, the laziest method of becoming a millionaire. I would like to share the screen. Yeah. Okay. So I was just talking to you that most of us wanted to become a millionaire, but then the why is something which most of us don't know. So let us see, why do you want to become a millionaire? Everyone should have some kind of a goal in your life. In fact, when you get down in a taxi, the first question the taxi driver is asking you is, where do you want to go? But if you don't know where do you want to go, then he has his own financial goals and he will take you to the place and he will make you go round and round because he himself has some financial goals. So let us see what can be and what should be and what are the normal financial goals for everyone in life. The first 25 years of your life is a learning phase. Then from 25 to 60 on an average, people are in the debt bracket. It's called as an earning phase. And the last is yearning phase. The first 25 years, your parents take care of your expenses. Then you start making money. Then one fine day, you will get married. Then go for kid one, kid two. Then you will have kid one college, kid two's college, then kid one marriage. Marriage does cost lots and lots of money, especially you ask Indians, huge. Kids two marriage. Then in this phase, you have to also take care of buying a car or buying a house or going for a vacation or going for a pilgrimage. You also have to take care of your golden retirement years where you are going to live for most of your life without making any money. So these are all your expected expenses which are going to happen, and you yourself can even calculate it today itself that how much are you going to need in regards to any of these requirements by way of seeing others and adding the inflation into it. I'll get into that inflation and all those things in my next slide. but you also have to take care of your golden years of retirement, because nobody wanted to compromise on the living standard, or when they retired, nobody wants to go down the living standard. You also have to take care of your emergencies. I always say there are 3 Ds in everyone's life. One is untimely death, untimely disease, and untimely disability. But today's seminar is not going to talk about it, although I also expertise into this. But for that, I will ask Anupama to arrange another session where we will be talking on those lines. So these are the expected expenses which are there. And see, all these expenses are expected expenses. Hold on just a minute. Yeah. These are our expected expenses, and emergencies are there. Retirement is also there. So now you understand what I'm talking about, that these are the goals of your, these should be the goals of your financial life. There is a beautiful saying, I don't know who has said, that those who don't work for their goal work for someone else's goal. Now, to reach those goals, you should have some kind of instruments, or you can say some kind of assets which can help you reach there. Like it's same as today you wanted to go from Dubai to Abu Dhabi. There are various ways and means. What are those various means? Is like either you can go on a motorcycle or on a car or in a public transport bus. But then based on what you want and based on your risk-taking appetite, you will choose that particular transportation means to go there. The same way, whenever you have to reach to some of the financial goal, you need to have an asset allocation based on your requirement, based on the time zone, based on your how soon you want to reach and how safe you want to reach. So the first type of asset allocation is fixed deposit, guaranteed return plans, or bonds. Very, not very safe, but quite safe compared to the other ways and means of asset allocation. The other ways and means are equity, in which there are mutual funds and direct stocks. And today we are going to talk only about the mutual funds and direct stocks. Third would be real estate, and fourth is futures and options and commodities in Bitcoin. What I mean by asset allocation is that the higher you go, the higher is the risk. And I'm not saying that all of them are not important. You can go as per your risk appetite in everything. What I mean by that is, suppose somebody comes to me and say that I want to buy a house in, let's say, or I want to go for a pilgrimage in 6 months time, what financial instrument I should go for? So for that particular person and for that requirement, fixed deposits are the best thing. You should not go and invest into equities, because equities, mutual fund, or direct stocks are a risky in terms of the returns. When we talk about real estates are also a good way of investment, but they are not liquid. One has to have a liquid asset as well, because if assuming that I have a house of 1 crore of Indian rupees, the value of that house has become 5 crores. But tomorrow, if I need, let's say, 50 lakhs to send my son for higher education, and I'm unable to find out somebody, so then this investment is of a no value to me. So real estate is good, but it's not so liquid. Futures and options nowadays, Bitcoin, and very risky, I don't know. This is another area of financial planning, or you can say another area of seminar. We can talk on this thing later on. Now, when we are talking about all these things, and when we are talking about your financial goals, we have to also take into consideration one biggest factor, and that is called as inflation. Now, what I mean by inflation is, in Hindi, you can call it as महंगाई. And in a lighter note, I can tell you that only the inflation affects not only the financial aspects of life, but even the physical aspects of life. To give you the example, when I came to Dubai in 24 years back, my waistline was 24, and today my waistline is 42. So this is an inflation which has affected on my physical note. Similarly, when you talk about value of money, today's expense of 30,000, whether it is dirhams or it is rupees or whatever currency you take it, today's expense of 30,000 will not be 30,000 after 20 years. the effect of 5% inflation is going to hit it drastically. So today's 30,000 expenses would be tomorrow's 80,000 rupees or whatever currency you are taking. Similarly, if you wanted to, or if you wanted to know that, Adil, I have 1 lakh of rupee or 1 lakh of dollars in my hand, what would be the value of this 1 lakh of rupee post 20 years? So post 20 years, your 1 lakh of rupee value would become 37,000 rupees. So this is the major effect which is going to happen. So you have to find out some instrument, or you have to find out some asset allocation, or invest your money in such a fashion which not only takes care of your growth but also take care of your inflation also, and your time value of money as well. Inflation is silently robbing you from of your purchasing power. Now, equity or equity related instruments are the best thing, and it has been proved not for 1 year or 2 years. It has been a proven fact that from last 42 years, equity and equity related investments have been able to deliver that kind of a return, which is called as a inflation adjusted returns are there. If you can see from this graph, from 2001, I could manage to only get something from 2001 to 2021. In this 20 years, you can see there has been numerous times when the markets have gone down, markets have been crashed badly. But over a period of time, if you can just see the central line, or you can say the way the market is going, is just going up and up and up only. And it has to grow, because if the market don't grow, then how the economy is going to run? And that has been proved with this graph as well. Of course, at this point of time as we speak, there has been some market is not in a great shape, but then over a period of time, this will be a small blip, as what you can see it in 2008, or you can see it in 2014-15, or you can see it in 2019 when the COVID hit. It will become a blip over a period of time, and this has been a proven fact, or you can say the records have been saying that. Now, what is mutual fund? There are two ways to get into the equities. One is mutual fund and another is stock. Now, in stock, you need lots of expertise, time, and if you can do those things, then nothing better than that. But then that has its own pros and cons. So that's the reason why we go for a mutual fund, because mutual fund does not need, and the theme, as per the theme, one should get into the laziest manner to get into or to become a millionaire. So mutual fund is the best instrument to get and become a millionaire. So what is mutual fund? Mutual fund is nothing but it's basically a pool of money where people invest their money, and from there you can invest into different stocks, different equities in whichever market you are getting in. Why mutual fund? The reason why mutual fund is just one. Mutual fund helps you to get into the risk diversification. What I mean by risk diversification is that, suppose if you have 10,000 rupees, with 10,000 rupees you might not be able to buy 1 or 2 shares of TCS also. TCS is Tata Consultancy Services. But what happens is that with your 10,000 rupees, if you want, you can buy the company of TCS also, or you can buy a company of Infosys as well. So by just paying some small amount, you become a part owner of those companies, and that's the best part of it. So that's the reason risk diversification. Smaller capital outlay, amount up to, let's say, 1,000 rupees, 500 rupees, one can invest into mutual fund to start with. I don't think so anybody in Dubai, in UAE, has such a kind of a salary that they can't save 1,000, 5,000, 10,000 rupees as an investment. There is an investment expertise. What I mean by investment expertise is that you will have a fund manager who will be qualified, not only qualified, is experienced as well. And these fund managers will help you see to it that you make more money than the market. Economies of scale in transaction cost. As an individual, when you go and invest, you pay a lot of charges. But when the fund manager pays, the charges are quite less. So you save some kind of a money over there. Variety of products. What I mean by variety of products is they have different kinds of products. It's one is purely diversified mutual funds are there. Something is called as sector based. Sector based means if I am interested in investing only in pharmaceutical companies, so there is a mutual fund which is only dedicated to the pharma companies, and you can invest your money into pharma companies. Similarly, somebody is not interested in taking risk. Their risk appetite is not that much, or maybe they don't have a time for investing into the risky affairs. So what they do is they invest into a less risky fund. So that is, those funds are called as debt fund. Debt fund is nothing but it's the corporate the bonds which it's basically a bond which invest into government securities and corporate as well. So that is more safer as compared to direct equities. Disciplined investing. Disciplined investing, what I mean by that is that I remember a client of mine, in fact, now he has become a client of mine. In one of those seminars, this guy stand up in the middle of a seminar and confronted me that, Mr. Kadri, I'm unable to save a single penny. How can you tell me and let me do it? I said, Mr. His name is Suresh. I said, Suresh bhai, today if your salary is, let's say, 5,000 dirhams, think of it that your arbab has increased the rental and he has increased your rental by 500 dirhams. So out of 5,000, can you save just 500 rupees on a monthly basis? And he said, let's try. He tried out for 6 months. And then he said, Adil bhai, I have never seen 6,000 dirhams at one go in my pocket. And this has just happened because he put himself, he disciplined himself for an investing. So mutual fund are the best thing for giving you a disciplined method or manner to invest. Variety of investment objectives. Now, majority of the people have different aspects. Somebody wants to just make money and they don't need any kind of an income. Somebody says, no, I want an income because this is my bread and butter. So he will invest a lump sum amount, and in the method of or in the manner of dividends, they can get the money from the from this mutual fund. So that's called as a dividend income that comes. Or somebody wanted to go for both. They wanted an appreciation also, and they wanted to have a income also. So you have an opportunity to invest there as well. Liquidity is the best part of it. What I mean by liquidity is that this investment is so liquid that at the click of a button, which I'm going to talk in another slide, at a click of a button, you can redeem the money. So in just 2 days time, the money will come back into your bank account. So that's the best part of it. Transparency is so much that where do they invest? They will let you know. The top 10 companies, they will let you know how much percentage they are investing, what is the current NAV as of the date, because every day they have to declare the NAV on the website as per the rule of SEBI. SEBI is Security Exchange Boards of India, which is again an authority, or you can say a body which keeps a track that nobody does any kind of a wrong thing in this kind of an investment. Tax advantage is in India, different taxes are laid upon different kind of an asset allocation. So if you have a property and if you sell that property, there is a different kind of a tax treatment for you. If you have a fixed deposits, there is a different kind of a tax treatment on that. But here the tax advantage is that you can save so much of money in tax, and the taxes are only that's called something as a long-term capital gain tax, short-term capital gain tax. So these are the various reasons for investing into a mutual fund. Now, there are various methods to do it. Lump sums are also available where, whenever you have some fund lying with you, you can just invest it. You don't want it to get into a commitment. Yes, you can get just lump sum invested into them. I have a businessman, his name is Joseph. And Joseph said, Adil, I wouldn't be able to commit to you on a monthly basis. But then, whenever I have a good business in a month, I will invest, and he is doing it in that manner. But most and the best thing to do and create a corpus is doing through a systematic investment plan. The reason why I'm saying systematic investment plan is that the advantages are there is no need to time the market. Nobody can time the market in this world. No one. You don't know when the markets are up, when the markets are down. So this is systematic investment plan releases you from that tension. So you don't need to time the market. Keep on investing on a particular date, and you will be happy in terms of your creating a corpus. Virtues of disciplined investing, we have all seen there. Discipline saving, there is a saying that drop makes an ocean. A drop of water done, if you keep on doing it for a long time, it creates an ocean. So this is the way disciplined investing, you can keep on doing it. Advantages of rupee cost averaging. Now the best example what I can give it to you, that off late I got into a COVID problem. So during those time, my son's exams were going on, and even he was in trouble. So he could not attend the classes, or he could not attend the exams. So the teacher says that we will give him an average mark. So suppose if he has earned a good amount of mark, or good marks in the previous test. So based on that, they have averaged it and they have given him the results. So that's called as a cost averaging, and he has passed with a flying color. Advantages of power of compounding. Now let us see what I mean by power of compounding. It's in a different slide. Now I wanted to ask a question. There are two options given to you, option 1 and option 2. Let's say your father gives you 100,000 dirhams for the next 31 days. Would you like to go for that? Or your father gives you 1 fields per day, doubling every day for the next 31 days. That means 1 fill he will give you today, next day he will give you 2 fill, then 4, then 8, then 16, then 30, 32, and it goes on till 31 days. How many of you would like to go for option 1? Any numbers? Samaya? Hello.
I would go for option 1, Adil.
Okay, very good. And how many of anybody for option 2? Very good. I can see them 2 participants raised hand for option 2. Let us see what are they going to make for option 1 and option 2. So in option 1, after 31 days, you will be making 3.1 million. And in option 2, you are going to make 21.4 million. And when I do this kind of a seminar for the kids, they actually start taking a calculator in their hands and start multiplying it and start challenging me. You can also do it. Take a calculator and just see. This is the power of compounding. Now, why equity mutual funds? We have gone and I have taken out some history of 42 years from the time the BSE Sensex has started. All of you can see that in the last 1 year, equity, and this is the records till 21. So this year's records are not there. Since last 1 year, the equity mutual fund have given 25% return, and the BSE Sensex has given 22% return. 3 years return, 2016. Likewise, in 10 years, and this is the compounding returns we are talking about. 15% return on an average, BSE Sensex has given for the last almost 15 years. If you all can see that. Now, the probability of a loss. Yes, I am still saying you, when you invest into an equity or equity related investments, there is a probability of your money going down. It is not as safe as a fixed deposit. But what is the point of investing into a fixed deposit, which gives you a 5% return, but the inflation is 7%. So you're actually making a loss of 2% on your amount. So that is a silently that inflation is killing your money. But here, equity mutual fund, the first year, the risk and the probability of the loss is 25%, means my 100 can become 75. But if I keep shut and then keep silent and just stay on that investment, the probability of losing my money is 18%. But after 5 years, the probability of losing money becomes 0%. And that's the best part of investing for a long term, which is anywhere between 5 and above. So you can see for 5 years, 7 years, 10 years, and the records have said that it becomes 0%. And these are all like back tested figures and facts which has been provided to you. It's not something which I have created from my end. Now let's see what is systematic investment plan or systematic investments can do for you. In a very simple manner, suppose somebody says that I can invest 15,000 rupees per month. 15,000 rupees is 750 dirhams. Now suppose on an average, the attendees are having an income of 7,500 or maybe 10,000. It's just a percentage of that money. 750 dirhams, which is 15,000. If you just invest it for 20 years, let's say, or 15 years, in total, you have invested 36 lakhs of rupees. What is going to give it to you is almost 2 crores of Indian rupees at an assumed growth rate of 15%, which is huge. The only thing which you need to do it is keep on just doing it. Believe in yourself, trust the market. Markets are not going to disappoint you in a long run, and you have to keep on doing it on a regular basis. In 20 years time, your 36 lakhs can become 2 crores of Indian rupees. Similarly, if somebody says, no, I can only invest 10,000 rupees, which is 500 dirhams. Now, in fact, it is less than 500 dirhams. See the magic. Your investments is just 24 lakhs, which has become 1.32 crores of Indian rupees, which is big, very, very big. 30 years, I don't want to even talk about it, because in the initial stages when we were talking with Anupama, she said that there will be youngsters coming. So that's the reason I don't know how many people in our seminar today, youngsters. But then youngsters, suppose if he has started his job at the age of 25 years, 30 years, they still have 30 more years for their retirement. And for 30 years, if they keep on doing it, it becomes an automatic millionaire. You don't have to do anything. And I don't buy that point that anybody who has or whose income is about 7,000, 8,000, 10,000 dirhams in this part of the world, and they are unable to save 15,000 Indian rupees, which is just 750 dirhams. So this is a scenario, and these are all magic. I mean, nothing which I have done it. These are all mathematics. It's just that you have to be on track and stay on the pitch. That's it. In fact, I'll give you an example of one of my support staff. She said that, boss, I am unable to save money. And I said, my dear, her name is Swapna, that would you be okay if you start saving some, let's say 50% or 60% of your salary, because any which way her husband is making a good amount of money as an income. She said, fine, okay, boss, let's start with something. So we have started with just 30,000 Indian rupees from 2008, 30,000 Indian rupees. Currently, she has invested about 12 lakhs of rupees of her own. And in spite of all those markets which is going down, she is sitting on about 14 and a half lakhs of rupees. And she said to me, boss, I have never seen 14 lakhs of rupees in my career or in my life. So that is the power of doing it on a regular basis. The best thing is that she don't watch television on market. Of course, she must be watching television, but then she is never bothered about what the market is going to give, what Donald Trump is doing, or what Mr. Putin is doing, or what is that inflation. Nothing doing. She's just investing 30,000 rupees on a monthly basis without fail. And today she's one of the happiest client of mine. Now let's see a cost of delay if you start your SIP in a real terms. We always procrastinate. We say that if we will not do it today, we will do it tomorrow. So here I have just taken two examples for both 15,000 and 10,000. you have seen that in 15 years time, if you start investing 15,000 rupees, in total you will be doing 27 lakhs of rupees, and your total amount which you are going to make in 15 years time would be about 92 lakhs 45 9.2 crores of Indian rupees in 15 years time. I think there is some mistake over here, my mistake, but let's see that. Yeah, there is one more zero, I think I put in more. Yeah, it's a typo error over here. So let's talk about 25 years. In 25 years, you have invested about 45 lakhs of rupees, and today, in 25 years time, it has become 4.13 crores of rupees. You just delay it by 12 months. That's it. Just delay it by 12 months. And in this 12 months delay, your 4.13 crore will be only 3.57 crore. That means your cost of delay is about 55 lakhs 62,000. 55 lakhs 62,000. In today's term, in today's value, it is about 12 lakhs 95,000, which is about 60,000 dirhams. If you just delay it by 1 year, think about the delay. If you do it by 1 year, 2 years, 3 years, then it's a huge difference. Same is the case for a 10,000. Your investment is 18 lakhs of rupees, and if you would have started today, now majority of people ask me that what is the best time to start any investment. So I said July is the best month, but the next best month would be October, November, December, January, February, March, April. So what I mean is any month is the best month. So don't wait for which month is the best or which day is the best. Tomorrow is the best day, or you can say yesterday was the best day to invest. Your 18 lakhs of rupees was supposed to be 61 lakhs, but if you just delay it by 12 months time, your delay is costing you about 9 lakh 16,000, which is in today's value is 3.8 the 38 3 lakhs 82,000. So that is also a big money. Same is the case for 25 years. So just 1 year's delay can take you so many years back. So think about it and start as early as possible. Now, cost of delay in starting a systematic investment plan, again in a real term, but then this time what I have done is that suppose if you wanted to reach to a goal of 1 crore of rupees, there are two kinds of investors, investor A and investor B. Investor A, 28 years is an age which most of us start our earning, or they would be regularly bringing in some kind of an income at home. But then he started at 28 years, and both of them invested till 58 years, because 58 years is the retirement, and their goal is to invest in such a fashion that when they retire, they should have 1 crore of rupees in there as a corpus. We assume 15% return. Can you see the monthly contribution, what Mr. A would be doing it if he starts at the age of 28 years? He will be only investing 6 lakhs 39,630 rupees vis-a-vis the guy who is Mr. B. He is going to invest about 7,500. He will be investing about 18 lakhs of rupees to reach to the same goal. So this is the power of starting early. Don't procrastinate, my friends. It will be a big time hit on your pocket. And that's the reason why I have deliberately shown you this slide, to show you the real-time impact on your money. How to do that? There are various places where you can start doing it. The banks are there. There are various places where you can open up the online account. You can connect with me. Even I am associated with a company where I can be also of a value to you. Where what we do is that we link your bank account with this, which is called online account or a demat account. We link your NRE or NRO account. You can go paperless, you can go digital, you can go online. Everything is all on the app. The best part is that you can keep on revisiting and keep on reminding yourself about your financial goals. Professional advice from a experienced and qualified advisor. You can treat him as your mentor, coach, or guide. Why I stressed upon this is basically the Sachin Tendulkar, the god of cricket. Even he has a professional coach with him. Because why the professional coach are required? I'll just give you one real-time case study. I'm having a client. His name is Imtiaz. This gentleman has started investing some funds in the Indian mutual funds. March 2020, when the whole market was crashed because of this COVID, he came to me and said, Adil, you know why I don't like this mutual fund? Because the markets have crashed. Look, today I'm at losses and I want to now stop it. And my luck is not with me. I think whenever I invest, wherever I invest, it's only on loss. So I'm going to quit. I'm going to call it a day. I told Mr. Imtiaz that, Mr. Imtiaz, I will give you 4 advices today, out of which 2 you can think of. The rest of the 2 I will not allow you as a friend. The 4 advice would be that if you have more money, start investing more, because markets have crashed, you will be happy. 2, if you don't have more money, let the systematic investment plan keep on going the way it is. Don't touch, don't bother, do nothing on that. Number 3 is that if you want to stop it, but don't pull out the money. And the 4th is something where you wanted to pull out, but I refrain, I will stop you, I will not let you do it as a friend. So think about it. So what he said, Adil, okay, since you are saying with so much of a confidence, let us continue the way it is. Now today, Mr. Imtiaz's portfolio, in spite of all the market crash, is on about 18% plus. Now, this is where I say that professional advice would be needed. From 2020, let's say not 2020, from 1998, if somebody has started investing 20,000 rupees on a regular basis, he would have invested 48 lakhs of rupees in total, which automatically would have had become 2 crores of rupees. So where does the requirement of professional advisor is needed over here? They are only needed because in this 20 years time, markets have gone down by almost 7-8 times. And at that point of time, the professional advisor or the coach will be sitting next to you, giving you that kind of confidence that since your goals are 20 years from now, don't worry, let the market work as it is. The only thing which you as an investor can do is keep on investing and keep on buying more number of units. You don't know what Putin is going to do. You don't have the control what Putin is going to do. You don't have a control on the inflation. So those are the factors which you don't have a control on. You only have a control on one thing, and that is called as your own investments. Keep on doing it on a regular basis. So this is what is I would recommend you open up an online account with someone, connect with me if you want to, and we can go ahead and make you all a millionaire. It's not difficult. It's very easy. Just few things to remember, which I have told you in the seminar, and you can do it. All from my side. Anupama.
Thank you, Adil. Would you please stop the screen sharing so we can see all of them? Yeah, thank you. Thank you, Adil. Thank you for that insightful information for us and for our audience. So if anyone has any questions, they can please put them onto the chat box. Sanaya, will you please enable the chat box, please? But I have a few questions for you, Adil.
Yeah.
Yeah. In the UAE, almost more than 40% of the workforce never thinks about saving. Yeah. So in this scenario, how can a financial advisor push them into that mindset where they can say that, okay, start saving as early as possible? What do you actually do for that?
See, most of us think that they are unable to save. It's like you are going for a gym, and let's say, I don't like gym, and I always have that feeling that I can't do any exercise. But then that first step has to be taken. In fact, my father always used to say these lines, and I always quote this. I don't know who must have said to him as well, that in this life, you if you trust everyone, that's a mistake, or that's dangerous. But if you don't trust anyone, that is more dangerous. So you have to trust your financial advisor or somebody who is more competent than you when it comes to financial planning or saving or investing, and start it. At least what maximum will you lose out? It's like you are just changing the pockets. I mean, I quote that same quotation or same example of Mr. Suresh, that suppose if your income is 5,000, and tomorrow if your bosses reduces your salary by 500 dirhams, would you stay in this country? And Mr. Suresh said to me, okay, we have to leave it because there is no other option. I said, okay, from next month, think that your salary is reduced by 500. So from 4,500, you spend your income, whatever your expenses are there, and then 500 you keep on saving. And there's a beautiful formula which I will always like to share it with most of us, is that what we do is your income minus expense, we think that should be our saving. Just change that. Income minus your investments or your savings should be your expense. Simple. I hope I answered.
Yeah, you surely did. You were talking about asset allocation.
Mhm.
The one thing that I missed from that is gold. So how far do you think investing in gold is good to be the fastest millionaire possible?
Thank you very much for reminding me. But then, as I said to you, gold is, again, I missed out in that slide. Thank you. I will just do an amendment in that. So real estate and gold and all those things are very good places to invest. But then my point is that if you just see the track record of 25 years, 30 years, 40 years, equity class has always outshined all the asset classes. Even the, in fact, the other day I came across with a gentleman, and he said, my father has purchased a property in Mumbai, and that was, he just paid some 5 lakhs of rupees in 40 years back, and today that value is, it's just 5 crores of rupees. I said, okay, let's put it in Excel sheet. And he has given some numbers. We just did the Excel sheet numbers, and it found out to be just 8% growth annualized. And on the top of it, this guy has paid a lot of money for maintenance of the house and for a lot of electricity, cleaning, maintenance, municipality cost. So the same thing goes with the gold as well. That gold, you buy gold, but then the problem is, where will you keep that kind of a gold? And again, gold comes up with its own risk also. So it can be a part of your investment into gold, but not fully. So I advise people to do 5%, 7% in gold, but not more than that. Yeah.
There's one more question that comes up almost every time that I'm talking about financial planning. Here in this part of the world, we are almost all are expats.
Yeah.
We have UAE, and then we have a home country.
Yes.
Yeah. So in this scenario, how far is it? Let me ask in the Indian context, because I'm an Indian and I invest in India.
Yeah.
So how far is it good for me to invest in UAE or invest in my home country? Because in UAE, the inflation rate is less compared to inflation rate in India. The instruments are global instruments, if I have to say.
Okay. Mhm.
Yeah, but on the other side, they're more Indianized. So what's your take on that?
I personally do it in this manner. Money does not have any color. Whether you make money in Indian rupees or whether you make money in dollars, it's almost the same. In fact, there are certain products which are coming in this part of the world where the underlying is Indian equities or Indian mutual funds, and you are investing to dollars. That means you wanted to keep the currency in US dollar only. You give Indian dollars to, I mean, you give US dollars to us. We invest in the Indian equities, and there also you make a money. You know how you make money? That when Indian rupees gives me 12%, 15% return over a period of time. So in spite of the inflation, in spite of the dollar versus Indian rupees exchange rate, if the exchange rate of Indian rupees versus dollar is, let's say, that it's called as, we called as the depreciation of Indian rupees is 4%. But if I'm making 15% return or 12% return or 8% return, I'm still making 4% on my dollar. Which instrument in this part of the world gives me 4% return? So whether you wanted to invest in dirhams or you wanted to invest in Indian rupees, you should be connecting with some financial advisor who can help you out that where do you want and what are your objectives, and based on that objective you can invest in dirhams also, or I mean UAE, which is because UAE dirhams and the dollar are pegged, so you can invest here also, or you can invest in dirham rupees also. If you ask me what I have done, I walk the talk. I have done it in both the places, because tomorrow I have my plans that I wanted to go back and retire in India. So I have done a provision for that in Indian rupees, and my little ones who are going to go for higher education, like my elder one is in Canada, I have done some savings in US dollars as well. And that's how the asset allocation works. Asset allocation does not work only with the in particular currency. Asset allocation even work in particular currencies as well, and in dollars also. Then you can invest in US dollar blue chip fund or US dollar emerging equity fund or whatever. So that's the way you have to diversify. But for that, you need a coach, you need a financial advisor who can take you through this particular exercise. Yeah. Hello. Hello.
Hello, can you hear me?
Yeah.
Okay, there's another question for you. We are
Please.
again UAE and home country situation. Yeah.
Yes.
If investing in UAE, do we get tax advantage? Because this is, we do not have any taxes here. So do we get a tax advantage in our home country?
Yes, as an NRE, we always have a tax advantage in our home country. But UAE at this point of time, as we speak, I don't know about what's going to happen tomorrow, because the corporate tax has come. So probably the likelihood of personal income tax coming in a few years is also going to be there. So when the income tax of UAE also started, then see, when you pay a tax, you get an advantages also from the government. So as an NRE at this point of time, we all are getting a great advantage of not paying an income tax in India. So one should invest if they are investing in India, so they can get a good tax advantage, because being an NRI, you're not liable to pay tax.
That's all questions that I have at the moment. Are there any questions from the audience? Then please put them on the chat, and Adil will be more than happy to answer them. So I give you about 2 minutes to plug in. Otherwise, we need to close the webinar because we have touched 8:30 exactly. So any questions from the audience? No, I don't see any questions from the audience. So Adil, we have come to the fag end, and this is my time to say a word of thanks. Thank you very much for coming on this seminar and giving us this insightful information. I was absolutely floored when we were talking about the cost difference when it comes to at the age of 28 you start saving, and at the age of 38 how much it impacts the monthly saving that you can actually invest.
Yes. In fact, this is something which we need to put it in the minds of our little ones, that the sooner they start, the better for them. I mean, it's the simplest and the easiest way which I have termed it in a humorous manner as a laziest way, but then it's the simplest and the easiest method to make money. So imbibe, or you can say put these things in your kids' mind, and they will not have a problem in future.
Problem. Absolutely. Thank you very much, Adil.
Thank you.
It was a pleasure. And thank you, audience, for being there for the past 1 hour listening to us. If you have missed anything or need a recap, this recording would be up on our social media handles soon. And we would send a link to for this recording to you on your emails. So if there are no any more questions, we say good night and see you
Thank
on
you.
our next webinar next month. Till then, bye.